New Year. This is our annual update on what we're seeing in the markets going forward. We'll give a very brief update of what happened last year and then spend the majority of our time on what we see happening. So next slide, please. There's our usual disclaimer. We're not offering any investment advice here. That has to be done on an individual level. So come and talk to us individually, and we'd be happy to take your personal situation into account. Next slide. So 2024 was a very strong year in the equity markets, I should say. You can see that Canada was up in the 20% range, and the S&P 500 was up 23%. Total return, including dividends, 25%. And the NASDAQ was especially strong at almost 29%. And then internationally, you can see it's mixed between the various countries, with France being the laggard. On the bond market side, I was surprised to see positive results here on the many bond maturities until you get into the long or above or over 10 years. And that has a great deal to do with the final quarter and interest rates coming off a bit, or at least on the short end, governments pushing rates down. We do see rates rising, and we'll talk about that in the future. Currencies, our Canadian dollar relative to the US was down almost 8%, and you can see the other choppy activity of the currencies against each other, with the US dollar index, the DXY, up 7%. So the US dollar relative to the rest of the world, the currency was very strong. Next slide. And over to you, Ken.
Perfect. Thank you, David. I'll just be quickly highlighting, as obviously we're talking about risk factors and a number of other things into forecast into 2025. You got to talk about a couple of big events, obviously, in North America. As of today, I think Donald Trump is in office as president, I think in 11 days. The Canadian Prime Minister obviously resigned just a few days ago. Obviously, both of those are factors in potential tariffs that are not only going to be installed against Canada, but other global nations by the US and the President Trump. But there also are other factors that we're really looking at on a macro level. We obviously got some inflation fears mounting. Obviously, inflation's come down. We've seen a tiny little tick up in recent months. There's some factors we think that can increase that rate moving forward, perhaps a little slower than last time. But we think that's leading to this charge in the yield curve, specifically the 10-year and the 30-year, the longer-term rates within the US and then other nations like Britain, where we're seeing surging interest rates despite central banks cutting, which is obviously what David mentioned at the forefront at the end of 2024. The Fed cut rates, but bond investors were hurt pretty hard in the fourth quarter. So we just had an election. Usually people talk about what the returns look like in election years, post-election years, midterm years, blah, blah, blah. These are the average returns for US markets, not Canada, in post-election years, so the first year of presidency. We've got about 3.3% since 1833, so that goes back pretty far, but then much stronger since 1981 when Ronald Reagan, that was his first term in office. So some strong returns since then on an average basis, about 13.6%. Beyond that, looking at the forecast from Bay Street and Wall Street, where they see markets going, they have an average return of about, I think, 12% they see this year for the S&P 500. You can see where the S&P 500 sits right now, about 5,900. Basically, every large institution has a much higher upside target. Now, Wall Street and Bay Street sell-side firms are predominantly not right, I will say. Last year, they all predicted a flat to down market, and the S&P was up, like David said, 23%. So take this with a grain of salt, but it seems like brokerage firms are pretty bullish right now. With all that being said, I'm just going to pass it quickly over to Joe to talk about the valuations of the market.
Yeah, thanks very much, Ken and Dave. I mean, the valuations of the market quite simply are high, and I think you have to look at it from, a near-term and long-term perspective. Going, what's long-term? First of all, I kind of think about it in the context of the post-war long-term average of the S&P 500, whether it's 16, 17, or 18, is not the point. The point is we're quite a ways above that, and so I think, as you look around, it's becoming more clear that stocks are getting a little bit expensive. They were more expensive, of course, in December of 2020, but that was COVID, and so you had a collapse in earnings. That's the denominator in the PE ratio, and so it spiked up even higher to just under 40. But as we record this webinar, we're at about 30 times on the S&P 500, getting close to double the long-term valuation parameter for the markets post-war. Again, you really want to be careful, cautious, and like we do here at MacNicol, the safe harbor approach to investing, we feel is really going to make the difference. So next slide. Now, one of the groups that we deal with is Universal Investments, and their director of research, Ronald Lagnato, put out a really great paper talking about valuations, and the real value of the valuations paper is what is sort of the go forward implications of that. It's really something I think a lot of us know. I mean, if you bought a house and overpaid for it, I think that can be problematic. But in stocks, it's really more the same. And so this line, the reason why it's downward sloping from left to right, quite simply means that the more expensive stocks you buy, the less likely you're going to have good returns from them in the future. So this is the Shiller PE ratio. Robert Shiller's a famous economist. And the CAPE is the cyclically adjusted PE ratio for stocks in the S&P 500. And you can see 10 years after overpaying for stocks, your returns are not so good. And so just like any financial asset, there's a reason why some are expensive and some are cheap. And you really want to be careful when you're making a decision to invest in either one. Next slide. Yeah, so we did want to hit on the cash point because there's a lot going around in terms of risk mitigation strategies. There's CTAs, there's sitting on cash, there's bonds, there's tail risk protection protocols, and sort of the challenge with some of them is that from an allocation perspective, going 100% cash is sort of it doesn't sound like an aggressive move, but it actually is, because you can compromise returns going forward. Other strategies come with, the potential pitfalls of, long-term dry spells, painful drawdowns in sideways markets, and the list goes on and on. But one thing we can point to here is Mr. Buffett in Berkshire looks to be increasing his cash weighting, and it's not a very outlandish call. I think if you studied Warren Buffett and followed him throughout his very, very illustrious career, you'll find that just like, a lot of us, he doesn't like paying any more than he has to for a good business unless it's a really good business. And that's, becoming harder and harder for his firm, Berkshire Hathaway, to find. And so you could see the results there in his cash allocation. His cash allocation is higher as the markets get more and more expensive, which is kind of the way it should be. And I think there's one more slide for myself. If not, I will right, mutual fund cash levels. So I'm the fund manager, and we have a little bit of a different situation at the fund level. Remember, the fund is intended to be managed to a mandate, so we can't sit on tons and tons of cash for too long. We do try to be opportunistic within the funds. We're always scrutinizing opportunities for the unit holders and for our investors. But you could see here mutual fund cash levels are at record highs. And so I think a lot of the quotes money is really asking themselves the same question, which is, do you want to be rolling the dice on an S&P 500 trading at 30 times, or even a TSX? Not really sure what the exact PE ratio on the TSX is at this given moment, but you can certainly see this very obvious inverse relationship where, again, stocks get more expensive and there's less and less, I guess, impetus on the part of managers to go out and deploy capital during those market environments, I think is the bottom line here.
Okay, I'll quickly go over a couple other pieces on the speculation front and market multiples. Just purely looking at these two charts, they depict two different things, but it just talks about the speculation going on in the market right now. That's the call to put ratio on the left. Obviously, the higher, the more bullish and speculative investors are. You can see how high it is relative to historical values. Only ever time it was higher was, I guess, in that when everyone was at home day trading, retailers were into that GameStop stuff back in late 20, early 21. And then on the right side, investors just locking into leveraged ETF bets. Leverage ETFs obviously magnify the returns of stocks or indices. So if the S&P is up 1% in a day, if you're in effects leveraged ETF, your account would be up 3 times. The only risk to that is if it's down 1%, your account would be down 3% in a day, and it magnifies so forth. Now, last year, a number of packages where leveraged ETF products were created for single stocks, Amazon, Nvidia, MicroStrategy, so you can see 3 times the return without going into margin yourself, but the ETF provider obviously goes into margin. And if the stock is down 30%, you would in reality be down 90% this year. So something to watch there. Speculation continues, especially through retail traders. And those two are depicted in these two mains. Crypto, obviously, we've talked about crypto recently. The last year, 2 years, 3 years, we've been looking into it, slowly diving into more, slowly studying the more quality names. But this top coin, obviously known as fart coin, has a market cap of about $1 billion, which doesn't seem like much, but something completely made up. It's pure speculation. There's no value. It's just investor interest and speculation. And then on the bottom, that's that Hawk Tua coin with that woman who became famous, I think, on that famous street in Nashville. Launched a coin and seemed to rug pull all of her investors. So people continue to buy into this stuff, and the rug gets pulled from under them every time. And we obviously do not recommend anyone invest into these kinds of things. The next slide I just wanted to highlight, it's kind of the opposite of the speculation. These are insiders, corporate insiders cashing out at the highest rate in over 20 years. This is the ratio of sellers to buyers, so obviously much more sellers right now. There are still some corporate buyers in certain companies where the insiders know there's real value in where the stock is right now, but a lot of these high growth names that have gone on these runs, Palantir, and even Bezos continues to sell off his stock, I think more to diversify his holdings, but some of these really high multiple names, especially Palantir, the corporate insiders are selling them, and there has to be a reason for that, obviously. If there is a bit of a market pullback, their wealth would fall substantially, these individuals, these insiders, and perhaps they've taken out major loans against their stock, and they might get some calls if the stock does pull back 20 to 30%. Just highlighting this, this is just a slide that talks about this is a 35 year chart that tracks the S&P 500 and Bloomberg US Aggregate Bond Index correlation. The closer to 1.0, the more correlated the two are. You can see this chart's at a 30 to 35 year high at 0.73 at the start of last year. That kind of continued last year because it uses a rolling 3-year correlation. Even though stocks were up massively, this chart is still, the two are still highly correlated, and that's why we obviously, in order to diversify our client portfolios, have looked to alternative assets, and our downside protection is through something we call the safe harbor fund, which many of you have heard of before. And this slide, there's 2 more slides, and then I'm going to pass it back to David. This is just investors turning their backs on stock selection, investing heavily into passive funds. A lot of people are just selling pure passive, buy the index, buy a basket of indices, and you'll be fine. It may be true over a 50-year period. If you're 20 and you're retiring at 70, you won't, and you're not taking any withdrawals until then. For the majority of investors, you need stock selection. Active management does pay. Obviously, the last few years probably not as rewarding as passive investing. Nonetheless, stock selection does matter. Quality does matter. Why do we say that? This next chart really highlights that well. These are 4 periods over the last 100 years where the S&P 500 was flat. There's obviously periods where I could highlight it in a 1 year, 2 year, 3 year, 4 year where it's down. But these are periods where it's flat, long periods. 1929, obviously Black Monday. It took about 24 years for the S&P 500 to return to its former high. Same thing in 1998 when it took 11 and a half, 12 years. 65, it took 13 and a half years. So that would be all the way to 78, 79. You would still be flat in the S&P 500. There are a lot of decades. We might have not seen one recently, but there are major drawdowns in lost decades, and that's why we think quality matters, and we continue to invest with security selection mattering, or we would just obviously index. And with that being said, I'll pass it quickly over to David to highlight two more charts on market valuations at this current point.
Great. Thanks, Ken. Yeah, so this is really all about market valuation and timing the market. That's the subject of our podcast today. And we believe we're bouncing off the ceiling, as SVA's charts show here. This is Ross Healy's company that puts a valuation on every company that we follow in North America, and then the indices themselves. And as you can see with these two major US indices, they're both bouncing off of resistance. Now, this is not technical analysis. This is actually the book value of the underlying indices. And that top yellow line for the S&P 500, it's awfully faint here right now. But the last time it bounced off this was in around 2000. It had another run at it back during the credit crisis. And now we see it bouncing off that top. It's just a reality that the market can't grow ahead of itself. The NASDAQ is fit even more perfectly with an even higher valuation, a higher book value valuation, but we see it bouncing off that at some point. With the market growing at the same time, it'll just be keeping up to that growth. And at some point this year, we're going to see some kind of a setback. Next slide. Yeah, this is always worrisome, of course. Armed conflicts are at an 80-year high. So they're going back to 1946, the end of World War II. You've had some frightening moments that we could put a flag on each one of these previous peaks. But the reality is the globe is at a all-time high. And we are hoping that this gets to this extreme. That's when things start to cool off, we hope. And we hope that cooler heads will prevail. Next slide. And then finishing up with gold and silver, we view them as one of the greatest hedges against inflation. As we've covered today, inflation is not under wraps yet. We think inflation will be a problem for the foreseeable future with higher interest rates, especially at the long end of the curve. And when that happens, and especially if we finally get a depreciating US dollar relative to the world basket, then gold will even catch a higher bid. But gold and silver act as excellent inflation hedges, and they're in a time of trouble. People and investors seek safety. And so this is why we're already well there, and we'll be continuing to add to our positions. Next slide. And that is it. So thank you very much for your attention. This is just a quick update for what we see happening in 2025. As always, feel free to reach out to us with any questions or comments. And we look forward to taking care of you this year. So all of the best for 2025. Okay.